Welcome to Connect, the podcast of the California MBA, where strategy, innovation, and leadership come together to shape the future of mortgage lending. This is where the voices and ideas drive our industry forward, and we hear real world execution. My name is Paul Gigliotti, CEO of the California MBA. And if you're here and listening, it's because you care about the business and you care about the industry, you care about housing, and you care about your clients. Before we begin and jump into what I know to be a brilliant episode, I'd love to take a moment to thank our 2026 President Council sponsors, AmeriHome, Consolidated Analytics, Loan DNA, Funding Shield, CMG, Rocket Mortgage, Wiener, Brodsky, Kinder, and Western Alliance Bank. Without the support of those organizations, the California MBA would not be able to do what it is that we do for advocacy and legislative initiatives. So thank you to our President Council sponsors. All right, here we go. Today, I'm excited to welcome Michael, CEO of Snapdocs, a company that has been at the center of transforming the mortgage closing experience for quite some time. Michael and his team are helping the industry rethink not just how we close loans, but how closing fits into the broader loan life cycle of the mortgage operations as well as capital markets. Well, Michael, thank you so much. Welcome to Connect Podcast.
Thanks, Paul. Pleasure to be here.
Yeah. I also have another a note to drop. We just found out a couple of days ago. We're thrilled to welcome Michael to the California MBA Board of Directors. Michael will be joining, starting his term on May 31st. So you get two welcomes during this.
Thank you. Yeah, very excited.
Yeah, it's going to be great having you. As already part of a robust board of directors. So, Michael, I don't know if you know this about me, but prior to coming you going through some technology and then obviously the California MBA, while I was COO of Pinnacle Home Loans, I owned and operated as a side hustle a closing fulfillment company. And the reason why I started that closing fulfillment company is because I truly feel with all my passion that the closing aspect of the mortgage lending industry has kind of been forgotten about. Like our industry is so siloed, right? Everything is, intake, customer acquisition, intake, underwriting, closing, and capital markets. And I often felt like the closing functionality was, something that wasn't focused on as much. And it was always really surprising to me because if you look at any story or any experience in your life, what you remember is how it ended, which is closing. So I'm thrilled to have you here today to talk about what Snapdocs is doing to support our customers, right? But as well as our lending, our IMBs and lending institutions, and ensuring a streamlined closing function.
Yeah. Well, I had no idea that you ran a closing support company. So you'll have a deeper perspective than most here.
Yeah. Well, I hope so. So let's jump in. Closing as a value chain. I want to start with something that I think reframes this entire conversation, and this is kind of what I was getting to when I was talking about closing as being part of the one of the most important functions in the mortgage loan life cycle. For years, the industry has treated closing like a feature, right? So e-sign, e-close, hybrid, almost like a checkbox process. But where we're starting to see closing really take shape is as an end-to-end value chain from clear to close through post-closing into secondary market. So how should lenders, from your perspective, how should lenders be thinking differently about closing today? And what changes when you look at it through a full loan lifecycle lens?
Yeah, it's a great question. So someone said this to me. I'm trying to remember who it was. I think it was Garth Graham at Stratmore said this. And if I'm misquoting you, Garth, you can yell at me later. But he made the point that the revenue event for a lender is selling a loan. And I sort of ran with that thought because what's really happening in the process is you spend to get to that revenue event. Finding a borrower is actually a cost event. You pay an LO, You spend a bunch of time and effort getting them credit approved. You get a loan put together. Like you have the opportunity to sell a loan. You are spending money to create the opportunity to sell a loan to secondary. And so I think what happens in that world is so much of that work is about creating that opportunity. It's easy to focus on that work, that pre-work. Um, and so that what comes out of that is a mental model that closing is just a moment at the end of the process, which is kind of how you described it. You get to clear to close, you execute the documents, you fund, you're all done.
Right.
The thing is like the closing is actually the highest leverage integration point in the entire loan lifecycle. And I call it an integration point because it's a point where a lot of things happen simultaneously. First, all the origination data is now gone from this is data in a system that we're checking and validating to this is data on a set of documents that is now about to become a contract that's very enforceable. Um, and then that contract is actually the collateral that you're now selling. So it's sort of this moment of truth where you're intersecting all of the data and work you've done, the paper itself, the borrower's intent, title's review of that loan to make sure they're comfortable with it. And at the end, you get this piece of collateral, and all those things have to integrate in a really compressed window, a very short period of time, days, where the docs are finalized, shared with title, signed, scanned back, and eventually packaged for sale. That window is really short, and it's where the errors are the most expensive.
Yeah.
And so when you zoom out to the full chain, three things get really clear. This is how we see it. First is that how you close and the quality of your closings process determines the quality of what you sell. So if your revenue event is selling loans, and it is, if you're a lender, then the quality of the product you sell is determined at this moment. It's determined before that moment in all the work that you did, but it's finalized at that moment. The collateral integrity, the document completeness, the data accuracy is all set at closing. The second thing that happens is the friction in post-close, conditions, repurchase risk, delays, is traceable often back to things that happened or didn't happen during closing prep and closing. Did you catch that error before you let the docs through? Um, and so the closing, when we think about the closing, it's not actually just the signing event, it's the setup. And there's an opportunity to check your closing documents and make sure they're right and make sure they tie back to the data that you input into your underwriting decision or whatever it may be. And then third, the lenders who connect the full chain, they're operating with a totally different cost structure. And I think this is we're going to talk about this a lot today. This is like really the big one. Um, because what happens is when you get this right, hundreds of dollars, I think actually probably closer to $1,000 alone comes out. I'm going to get into a little bit if assuming we the conversation goes where I think it's going to go. I'm going to get into why it's such a big number. But it's a combination of, yeah, everyone's deploying AI for sure. We're deploying AI in our product. Everyone's reducing labor, sure. But there's actually cycle time reduction and error reduction, and you can't sleep on those. Like they're actually really big. And then you also have better execution with secondary, and these things stack up. So it's sort of the situation where you can spend a lot of money, do it poorly, have it take a long time, and have it have errors, and all those costs stack up. But there's a version where you do it automated, you spend less money, you do it better, you do it faster, and all those costs compress. There's almost two options. There isn't really an in between. And so that to me is like how a lender should think about closing.
Yeah, that's a really you put it out there plainly and compared side by side, right? My question to you, well, one of my questions, I have many questions for you. Um, our discussion rolls, we're talking about immediately an ROI from a lender's vantage point.
Yeah,
When we talked a little bit about risk. What I'd love to talk about really quickly before we dive into risk and ROI is what about the level of service that goes to not only, so from a lender's perspective, like, when I was running Pinnacle Home Loans, I would look at the fact that I had two customers, right? My originator
right.
was a customer. We're a retail organization. And then the consumer was a customer.
Yeah,
So before we dive into risk and ROI a little bit, can we also talk about um, how to look at closing from the fundamental
yeah,
perspective of level of service, right? Because again, when we jumped in and I came in like a steamroller and I said, I think closing is one of the most important aspects, if
Totally.
not the most important, almost
Totally.
more important than bringing the customer in, acquisition, because it's what they
Yep.
remember, right? So
Yep.
can we talk a little bit, and feel free to talk about how Snapdocs supports
Yeah.
that level of service?
Yeah. And I'm glad you asked that because you know, usually in operations, because closing is a back office. It's an operational task. It's done by closers. It's a lot of operational work, right? It's not sales.
Yeah.
Usually in most businesses, even just like thinking outside of mortgage, the classic trade-off for an operations team is cost and customer experience, right? It's, do I want to staff more people on my support call center and have shorter wait times, or do I want to save money and have longer wait times, right?
Yeah.
Those are the kinds of trades. The thing about digital closing is it's actually not a trade. It's quite the opposite, where we're really in a place now where most people buying or refinancing homes are of an age where they're expecting a digital experience. They are not wanting this process to take a long time. We know that paper loans have errors in them, at least one error, something like, it's a huge number. I'm going to say 70% is what I remember. I
Yeah.
believe it's 70% of the time.
Wow.
This whole process, by the way, from application to shipping the loan to secondary, on average is 70 days. Now I know a lot of lenders do it faster. You start getting into loan mix and my refi only, my only doing HELOCs, it's going to get a lot faster. But I'm talking about just average. And
Right.
70 days is super long time.
Yeah.
And so when you digitize the closings process, and we're going to talk about ROI and all the dollars that fall out of that, a lot of those dollars come from the fact that the cycle time is shortened and the errors are fewer. And so the result for the borrower is they're less likely to have one of those hiccups at the closing table or 2 days before closing that causes them to say, hey, this was terrible. And they're less likely to say, why is this taking so long? And they're less likely to have, difficult conversations about rate lock expirations or whatever else is there. All of these things can really upset a borrower, and all of these things get mitigated on a portfolio basis. It's not to say that they're never going to happen. They're going to happen a lot less when you shorten the cycle time. Snapdocs average application to shipping a loan is 52 days, not 70. That 18-day reduction is super
Wow.
meaningful, right? And borrowers are going to feel that. A lot of folks in the process are going to feel that. And so that is like, and by the way, we've also done studies on this. Like we did an NPS. Lenders moving to Snapdocs had on average a 10-point NPS lift. So a digital closing product that is working across your entire portfolio. Closing one loan digitally makes one borrower happy. You got to do them all, right?
Right.
But if you have high adoption, yeah, you'll have those results.
A lot of the industry has an understanding as to what Snapdocs does, around e-closing or hybrid closing, but I think there's a lot more there. Why don't you take a few moments and share with us and our audience the products that Snapdocs brings to the table for our
Yeah,
lenders?
happy to do that. We've kind of stopped calling a lot of the products. They've really become features on our closings platform. Um, so I'll start with the history. The first product we built was in 2013. It was the founding product. It was notary scheduling. It's very penetrated now. About 1 in 2 mobile notaries is scheduled on that platform. Our founder wanted to digitize closings, and so he moved to build digital closing in 2017. And that product, as first envisioned, really is you identify all the places in the documents where signatures, dates, and notary stamps go. You apply metadata to the documents. You effectively digitize the doc package. You decide how it can be, which docs can be signed digitally on a phone or tablet, and which need to still go to title and then be routed to a notary. And then at the end, it reassembles that package. And that is a pretty, you know, at the time, it was groundbreaking. We were the first, and we're the only,
Right.
big sort of pure play digital closings company. But I think a lot of folks have products similar to that. What's happened since then is we've realized that when you digitize at a very high rate, and this is one of the things that we're known for, is not just having a digital closings product, but getting people, our lenders, to 90, 100% digital closing adoption. Once you've digitized that process to a really high rate, you can do a lot more things. So the most obvious thing that we realized was you can now start doing e-notes at scale. So we built a vault and we started doing e-notes at scale, and that takes a bunch of cost and time out of the process. And an eVault is a product, but when I think about it inside of the digital closing experience, it's a feature of doing digital closings. You can also start doing RON, remote online notarization. Once the docs are digital, you can perform digital QC. And what's interesting about that is the back office, and I talked about the back office earlier,
Right.
the closings process, both pre-close and close itself, there is an enormous amount of stare and compare going on. Does
Yeah.
this match what's in the LOS? Does this match what I saw before? Is this the version that we're going to sign? Like, what changes have been made since last time? And that would be two screens and someone basically going like this with their head for, a period of time. And all of that work can be automated when you are digital. And so we built products that do that. Um, Really simple example, our first QC product, which is now a feature of the closings platform. We built funding QC. So in table fund states, you have an obligation to fund as soon as the loan is signed. And so what a lot of title companies or lenders will do is they will insist on, hey, I need 15 minutes to quickly thumb through this and make sure I've got all the signatures. I don't want to fund without a complete closing packet. That 15 minutes is now less than a minute. And there's real labor in there. I mean, you've got a busy office in one day, and you don't want people spending time on that. And the product is at a very high accuracy. Then we built a more robust post-close product. It's called post-close QC, and it does a lot more than that. Now it checks all of that, but it also checks a lot of the conditions that are in the LOS. Do the fields match? Is the data correct? Like some of the basic calculations that you would run, loan to value, names, dates, et cetera, these exactly what we would expect. And then now you can package up this loan and sell it to secondary. And what we are seeing with lenders on that product, we had one lender buy that product, and one of their preferred secondary market investors called them up about a few weeks after they started using it and said, "Did you change something? Because your loans are going through our first pass and getting approved on first pass at a really high rate, and you used to have a lot of issues."
Yeah.
And so this company both no longer has a post-close QC team and is getting paid faster for loans. And one of their secondary market participants actually started giving them a rebate, paying them more for loans because they have to do less QC to buy the loans.
Right.
That's the kind of
Dwell
efficiencies.
time, all of it. Yeah.
Yeah. We built a product or a feature, I should say, called trailing docs. Obviously, when we receive trailing docs, these are like the recorded title, those get mailed. And so even in a digital closing, you've got this paper process on the back end. So we said, hey, why don't you upload those and we'll digitize them and add them to the closing packet. And we're getting pretty close to a partnership with custodians to digitize sending the trailing docs to the custodian so that no part of handling trailing docs will be paper, and that will take costs and time and errors out of the process.
Yeah.
We're also early now. We've got a handful of lenders using a CD balancing product. So one of the things that happens in every purchase and refi loan is you've got to balance the CD. Purchase is harder. And so you've got people, especially at the end of the month, I hear closers can spend half day, 6 hours a day just balancing CDs. But if you think about what that job is, it's looking for discrepancies and then doing calculations, raising where the discrepancies exist. We built a model that can do that. And so we're sort of on the rampage to basically identify the work that can be done digitally and to do it. Um, AI has put a wind in our sails, but we were doing a lot of these things with machine learning and workflows before. So we view AI as yet another tool.
Yeah.
But our focus has always been on the job to be done, just making tasks and toil go away and empowering the teams to do more with less.
Yeah, and I loved hearing that explanation because when we first started talking, I laid it out as if Snapdocs has a myriad of different products, and your response to it is it's actually one product. They have features, and it makes sense now that you're saying it because it really, your solution takes you from beginning to end throughout the
Yeah.
entire process. I mean,
We've
when you
we've
were
come to realize that it's we used to call it products. When we shipped a lot of these new things, we would call our existing closings customers and say, "Hey, check this out, try this." And so
yeah,
we were exposing them to those new things. But when we onboard new lenders, they're often buying everything. They want all of the automations.
I bet.
And so we realized we're really just selling one thing.
Yeah.
which is,
Oh,
hey, we're
wonderful.
trying to do a fully automated closings process that is way less labor intensive, way faster, way cheaper, and has fewer errors.
Yeah, it's brilliant. I want to throw out a terminology that I would almost throw out like as a parent to our kids and say back in the day, because as you were talking, I was going through the pain of when I was the COO at Pinnacle Home Loans and the closing and the trail docs and the balancing of the CD and, cost to cures and just how much work that was on a manual process. And now with Snapdocs,
Yep.
not just because of AI, but with the solution that you bring to the table, that's a huge, huge lift. As we were saying, not just for, looking at, your ROI and looking at being your competitive advantage, but really as solutions and service to your customers. I mean, that's enormous. Mike, as we look into 2026, I just have a real quick one last question for you. As we look into 2026, what should lenders be preparing for next as it relates to closing? So when you're looking at Snapdocs and your competitors, what do you think's coming down the pipeline as what's next?
I will say, we're growing rapidly.
Yeah.
We have been for years. It's not slowing. And I think it's because we are the only company that is obsessed with this process. There are a number of companies who built e-close platforms that do this first step, right? The digitize the loan and do hybrids and it's but to then sort of methodically start working through, well, what are all the jobs to be done? What are all the places that people are doing things and can we make this better, faster, cheaper? I don't see any other companies with that vision and that ambition that to chase that problem. There are obviously many highly visionary and ambitious companies in our space. And so what I would flag is first, the capability gap is expanding rapidly, right? There are still a good portion of loans in the industry that are not digital at all. Like
Mhm.
I could name names, but there are like some big, well-known banks who have not bought any digital closing product and are closing in paper on 100% of their loans. And we're still in a world where they're doing that. We're in a world where more than half the lenders are doing them digitally, many on Snapdocs. And then we're in a world where there's this growing group of lenders who are now adopting all these features we're building, and they're rapidly taking costs and time out of their process. And so if you're still at the front end of this journey and you haven't invested in that capability gap, the difference is going to get profound, right?
Yeah.
We have lenders who are very close to I mean, once we finish shipping all of these tasks, the next step is just put an agent on top. And that's sort of the last step,
Yeah.
right? And
Yeah.
I don't know that that's a this year. You said 2026. We still have, we talked about CD balancing and two of the QCs. There's still one more QC we want to build. There's a couple more tasks we want to automate, and then there really won't be any left in the closings process.
Yeah.
Maybe 2027, right? And imagine in 2027 we've delivered that, and there's a lender who's not doing anything digitally at all.
Yeah.
That's a huge gap.
That's enormous, and they're gonna feel that. And again, and I know I've said this a couple times, but I think it's really important in your position and what you bring to the industry for both customers. For the originator, the originators are gonna wanna see that solution within the organization they work at, as well as what the consumer's expectation is. They demand it now, you know?
And then I think the second thing that I expect to see in 2026 and beyond, we're seeing this already. I kind of talked about it with the one lender who's had this really great experience on post-close QC with their secondary market partners. This idea that closing is more than just the event, but it's actually the point at which the collateral is set. We really think of ourselves now as the digital collateral company. We don't think of ourselves as much of a digital closing company, as much of a digital collateral company. And it's the convergence of closing and capital markets. It's the realization that the
Yeah.
decision to buy and roll out a suite of digital closing features is actually more than an operational decision. It is a capital markets decision. Is a decision about the quality of your collateral and your execution on the secondary market. And the lenders who get that and have leaned way in are seeing that result in secondary. And I think that those 2 points intersect. So this idea that like the technical capability gap is expanding and the convergence of closing on capital markets is a thing, is that this is the best place to deploy technology. I've said this for a couple years now, and I'll make the point, which is this is the back office. The back office is where you have tedious, repetitive work. It is perfect for technology. It is perfect for AI. Like, yeah, you have to train it, but like the judgment is lower risk. Look, if it misses a signature, humans are missing that signature today.
Yeah.
You're not creating a risk. It's not the same kind of risk where if it makes a faulty underwriting decision, Freddie issued a bunch of rules around that, right? Like you 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 are taking a low risk, high expense problem and solving it. And that is like the perfect place to start.
Yeah, absolutely. It's prime for everything that you're doing, and it's very impactful in the industry. This was an absolutely powerful conversation. I really appreciate you joining us and sharing your perspective as a thought leader, and sharing about Snapdocs and your purpose and mission behind it. Also, welcome to the board,
Thanks
and
for having me in both respects.
yeah, I look forward to hearing more about Snapdocs. You're going to be involved in MIC 26. You guys will be on stage a couple times. You got a tech talk and you've got a tech demo, so we'll be able to see this all in real time, which we're looking forward to.
Yep. Thank you.
Um,
I'm looking forward to it as well.
yeah, yeah. To our audience, thank you for tuning in to Connect. This is exactly why we have these conversations, because the future of this industry isn't built in silos. It's about the end-to-end solution, from top of funnel till post closing, and it's built through alignment, innovation, and execution. So this is a very very perfect conversation. Again, thank you, Michael. Until next time, stay engaged, stay sharp, and keep building with purpose.